The ongoing crash in the international automobile market is expected to bring about significant impacts on consumers, sellers, and car dealerships. As we ventured into 2023, the American auto industry was in a large bubble with record-breaking prices for new cars and used vehicle rates rising to a staggering 42% above what they were in 2019. A range of factors are now causing car values to plummet. Concurrently, auto loan debts are reaching alarming heights, and even borrowers with commendable credit scores are finding it difficult to keep up with car payments, leading to vehicle repossession. An industry leader has cautioned that this could plunge the nation into a grave financial crisis, and the fast-paced downturn suggests this forecast could be true. In this video, we've gathered 12 signs pointing to a significant auto market crash currently in progress. But before we explore this list, we kindly ask you to support us by giving this video a thumbs up and subscribing to our channel. Without further delay, here are the 12 signs indicating the impending automobile market crash. Number 1, the average price of a new vehicle has hit an unprecedented high, with rates reaching $50,000 in February of 2023, compared to $38,948 in December 2019. This indicates the steepest price ever recorded for a new vehicle. Concurrently, the typical monthly payment for a new car has risen by 26% since 2019, now at $718 per month. Worrisomely, about 1 in 6 new car buyers are spending over $1,000 a month on their vehicles. Other related expenses, such as insurance, fuel, and maintenance, have also spiked, making it increasingly difficult for most Americans to afford these payments. Number 2, car repossession rates are increasing, even among those with good credit scores. According to Barron's data, vehicle repossessions are surging, including among prime borrowers who have strong credit scores and are seen as the least likely to default on their loans. Repossession rates among these prime borrowers have doubled, indicating a worrying pattern. Repossessions are not confined to subprime borrowers. Even those with good credit scores are struggling with auto loan payments. This not only increases the risk of vehicle repossession, but also has negative long-term effects on other areas of personal finance, affecting credit scores and overall financial stability. Many Americans are already falling behind on their car payments. Number 3, an increasing number of consumers across the country are having difficulties meeting their car payments. Financial analysts worry this trend will persist. The lowest-income consumers are facing the highest rate of loan defaults, exceeding levels witnessed in 2019. In just January, loan defaults increased by 6.2%, which is a 33.5% surge from the previous year, as per rating agency Batch's data. Number 4, all car models have seen a remarkable and unsustainable surge in price in recent years. As the pandemic hit, car manufacturers anticipated a drop in car demand, leading to decreased production. This, coupled with a shortage of new cars in the market, led consumers to buy used cars, using stimulus bonds and benefiting from low interest rates. Consequently, the prices of used cars soared 4 times faster than the new car industry's growth. This resulted in a temporary and unsustainable hike in used car prices, creating a large bubble now on the verge of bursting. Number 5, the situation is worsened by rising interest rates. The Federal Reserve's aggressive credit tightening cycle is further undermining car affordability. In 2021, the average interest rate for a new car loan stood at 4.1%, while for used cars it was 7.4%. However, borrowers now face an average interest rate of 6.5% for new cars and a daunting 10% for used cars. Experts caution that this rise in interest rates could result in a $22 billion sales loss in the car industry. Increased interest rates make borrowing more costly, thereby decreasing demand for used cars. As a result, consumers may purchase 150,000 fewer new cars and 500,000 fewer used cars this year, according to Edmunds's data. Number 6. The rise in vehicle repossessions is alarming, exceeding the capacity of repo men to handle the current demand. Jeremy Cross, president of International Recovery Systems in Pennsylvania, discloses that the heightened need for repossessions makes it hard to cope. There's a dearth of repo men and not enough space to store the repossessed cars. Cross refers to it as the perfect storm, anticipating the volume to keep growing, possibly reaching levels akin to those during the Great Financial Crisis. Number 7. In 2022, the car market recorded its worst sales in a decade. A mere 13.7 million vehicles were sold, marking an 8% decrease from 2021 and the lowest since 2011, as per data from research firm Ward's Intelligence. To give this context, car sales had surpassed 17 million annually from 2015 to 2019. Stellantis, the parent company of Chrysler, Dodge, and Jeep, experienced a 13% slump in U.S. sales in 2022. Honda faced a 33% drop, Nissan reported a 25% reduction, and Toyota, the top car manufacturer globally, saw a roughly 10% decrease in U.S. sales. Number 8. Auto loan debt hit a record high in 2023, making it the third biggest debt category after mortgages and student loans, as stated by the Federal Reserve Bank of New York. Americans are in debt of an astonishing $1.5 trillion in auto loans, comprising 9.2% of U.S. consumer debt. Number 9. Car purchasers nowadays are taking longer than ever to pay back their auto loans. In 2019, the average auto loan term was 44.5 months for bought vehicles and 24.2 months for leased ones. However, researchers at Experian observed a significant increase in the average auto loan term to 69.7 months for new cars, 68.1 months for used cars, and 35.9 months for leased cars. Moreover, over the past year, there has been a 25% rise in auto loan terms, extending from 72 to 84 months. Number 10. Tesla is undergoing a major drop in prices. Just a month ago, Tesla's CEO Elon Musk raised concerns about the economy and a possible recession, potentially indicating a warning for the auto sector. To tackle this, Tesla announced a 10% reduction in its workforce this year. But job cuts aren't the only strategy in place. Over recent years, Tesla had been hiking up its new car prices, with the Model Y price rocketing to $77,000. By January, the model had depreciated by $13,000, leaving many Tesla owners upset and feeling cheated. The present selling price for the same model is $52,990, a substantial decrease of $25,000 from its height. As a result, those who recently bought a Tesla Model Y might already find their loans exceeding the car's value. Number 11. Carvana, often dubbed the Amazon of pre-owned cars, is grappling with a serious decline. The firm's stocks have tanked more than 36% to $4.27 this month amid rising worries about Carvana's capacity to meet its payment deadlines. The stock has been on a downhill trajectory, shedding 45% since early December, with a sharp plunge of 43% in November alone. Carvana closed 2021 at $231.79, but has since plummeted 98% since January 2022. The central question now is whether the firm can steer through this tough period without becoming bankrupt. Bank of America Securities points out that Carvana is likely to exhaust its cash reserves by the end of 2023 unless it manages to secure more funding. Although it's improbable that the firm will go bankrupt, given the potential for stricter credit conditions, the situation is unpredictable. Number 12. On a brighter note, chip manufacturers are finally meeting the demand. Goldman Sachs reveals that chip makers are boosting production to cater to global demand. This surge in chip supply will allow car manufacturing to resume regularity by mid-2023. As auto manufacturers secure the necessary chips to produce a steady supply of new cars, inventory will level off. This will, in turn, lead to a reduction in the demand for used cars. J.D. Power anticipates that both new and used car prices will experience double-digit drops by year-end due to this shift. The car market's crash can trigger widespread repercussions that could plunge the entire nation into chaos. It's crucial to realize that the car industry in the U.S. holds a significant place in the national economy, creating millions of jobs and generating billions in revenue. A downturn in this market could lead to a harsh economic slump, causing vast job losses, insolvencies, and a stark decrease in consumer spending. Moreover, the effects would spill over beyond the car industry, upsetting the supply chain for many other sectors. Car manufacturers depend on a broad network of suppliers, and when the crash occurs, it'll trigger a domino effect of disruptions throughout these supply networks, affecting diverse industries. It's essential for everyone to keep a keen eye on this crisis's unfolding, as it will ultimately impact us all. The repercussions of a car market crash are extensive and should not be downplayed. Thanks for tuning in.